Good afternoon, everyone.
Good evening.
Hey, how are you?
Good evening, pretty good.
Evening, Shaniqua, Monique. Just giving the others a few extra moments before we begin. Does anybody remember which week we are in today? Has anybody been keeping track?
I think we're in week 8.
Yes, absolutely. Monique, what made you so certain?
Last week I said 7 or 8, and I think 7 was the correct answer last week.
Yes, yes, indeed. Yes, indeed. So we're in week number 8 already. I thought I had sent you the additional materials that you guys I was supposed to send, and then I discovered in the middle of nowhere, oh my God, I did not send it. So if you have access to your personal email, I just sent 2 additional modules that we'll be covering this week and next week, and then I'll be sending you another 1 or 2 more for our final session. So if you have access to your email, you can check it out. The first one is vouching that we'll talk about today, and then next week, verification of assets and liabilities by the auditor. And then I think the other 2 has to do with the internal audit. And finally, audit and ethics. So time flies when you're having fun.
It sure does. Mr. Wilkinson, can you send the modules to my personal email address? I think you only have my work email address, so I did not get it. Well, I sent you an email. I'm not sure if you received it.
Did I ask you that last week? How was it? Next one
Uh,
exam?
No, I sent it on Saturday or yesterday.
Okay. Did
I can give it to you now. asksugarpaulrussell@gmail.com.
it's a new email contact?
Yes.
Okay, let me see if I had in fact. 1 second. So that's where I need to send your material then.
Yes.
Okay. So let's see what I have found here. Yeah, Russell at Gmail.
Yes, that's it.
Great, great, fantastic. So when we're done, I'll send it to you. If you don't get it within 1 hour after class is dismissed, please drop me another note so I can send that material to you, Jennifer.
Okay. Now I don't have the modules, so I need those to follow
Oh,
this
you have
evening.
access, you can access them now?
I don't have access. I don't have access to my other email no longer.
But if I send it to you now to this new email address, you'll be able to access it?
Yes, let me check. Sorry.
Okay, great. Let me send it to you to that new email.
Yes, I got it.
You got it?
Yes, I do.
Okay, lovely. Should be 2 of them.
Let me see.
Vouching,
Vouching.
verification.
Yes, I see vouching, and the other one is there as well. Yes, I'm good now. Thank you. Verification and valuation of assets.
Right, right.
Yes. Okay. Thank you.
All right, so we have that down again. I have two more modules to send you. We have tonight, week 8, 9, 10, and 11, before our final exam on the week number 12. Did I tell you when your case study is due?
Before week 12.
Yeah, on or before week 12.
Um,
On or before week number 12, okay? So if you're done before, you can send it in, but if you get stuck for some reason, you still have until the final week of class to submit your cases. All right. Also, like I said, I have two more modules to send you. If you don't see them within 24 hours, somebody send me a siren and say hello. Those two. And I'll certainly be sending them out to everybody. For those of you who just checked in, Javon and Brian, did you get the emails I sent a few minutes ago? Two modules. Javon and Brian.
Yeah, good night. I just got it.
Wonderful, Javon.
I have them.
You got them?
Yes, sir.
Great. So I'll be sending the other two to those very same email addresses. Once you get them, if you acknowledge receipt, then I'll know that you've gotten them. If you don't get it within 24 hours, send me an email and say, I didn't get it for some reason, and I'll go back and see what happened. But if you got the ones I sent a few minutes ago, then you should be fine. All right, so we're in week number 8. Your examination grades will be coming through sometime by the middle of this week. I'll email the results directly to you. And of course, if you have any questions, you can always raise them during the class on Monday. Okay. Okay, Letitia. I see Letitia there somewhere. She'll join us. Brian, of course, is there. Just spoke with him. Javon, yes. I spoke with Javon. Shaniqua, of course. It's there. And who's last but not least? Monique. Monique, are you there?
Yes, I'm here.
Okay, lovely.
Hi, Mr. Wilkerson. I'm here. What happened? I'm on the road. I should soon be settled, but I am on the call. Thanks.
Okay, well, just don't look down. Use your ears, not your eyes, until you get home. 1, 2. Okay, fantastic. So, Indira, that's the person who's missing. Indira will join us in a very little bit. So last week, does anybody remember what our conversation was last week? What did we talk
Internal
about?
controls. Internal
Yeah.
controls.
Yeah, internal controls. And we said, remember that.
Good evening.
Hi, is that Indira?
Yes, sir.
Okay, how are you, Indira?
I'm great, and yourself?
Fine, just fine. We're just getting started, so you're right on cue. All right. So yeah, we talked about the internal control system that is conducted from the inside of the organization, and how the internal auditor or internal audit department conducts its operational accounting and other administrative checks, looking for very specific things that are supposed to be consistent with the company's policy and procedure. By the way, anybody in this class has ever been a part of an internal audit process? Does your organization have an internal audit department or person?
Yes.
Yeah, okay. Usually what happens when they come around, internal auditors? What's a typical 1 to 2 hours for them? Anyone?
You said what's a typical what?
Activity for them when they're doing their jobs? What do they do?
They come around and they look, you know, they ask questions and well, when I used to work at an insurance company, what they did was they would usually be with us for like a week or 2 weeks.
Yeah.
And
too long.
they go out and they analyze all of our clients, every client that we have coming in, how they pay, when they pay, to make sure that they do pay, make sure that the match with the books.
Yep, absolutely. And this is pretty much the job of the internal auditor. They're checking things to see if it's going according to plan, according to policy, and the procedures are being done correctly. Somebody's mic is open. Like a spike going. Okay. That's your mic. Nisha. Okay. Must be the breeze that was blowing through as we try. All right. So yeah, she says they came around, look around, ask questions, check stuff, make sure things were correct. They're looking for errors. Are they looking for fraud as well? Wrongdoing? Anyone? Internal auditors?
Yes, definitely.
Yeah, definitely. They're looking for fraud to make sure that people and staffers are not trying to run their own program. They're not stealing money, not stealing materials, all this kind of stuff. If they go to the accounting department, they're checking to see if the accounting people are processing transactions properly from start to finish, that money's being deposited daily into the bank, that more than one person is doing different responsibilities. All these kinds of things the internal audit department will do. And of course, we said also that this internal audit function is very important to the external auditor, because the more confidence the external auditor has in the internal audit process, then the sooner the external auditor can get out of the firm as quickly as possible. Because if the internal audit work is done pretty well, then the external auditor can simply rely on a lot of the information that is recorded by internal audit and save everybody a lot of time and stress by not duplicating the same processes. Okay? So these functions are absolutely critical to any organization. And any organization that is not subject to audit, I guarantee you something is wrong or will go wrong very soon. Even firms that are being audited on a regular basis still suffer from errors and frauds and theft and all kinds of crazy stuff. Misappropriation, improper accounting, improper procedures. And these are companies that are being audited. So if there's an entity out there that is not being audited, and again, if you're a small business and you can't afford to get a formal auditor, you can just hire somebody with accounting experience. Ask them to come in and take a look at some key things for a couple of bucks. Save yourself some stress potentially. Okay. And we'll also send a message to your employees that, hey, somebody's checking other than the boss who's not checking. Because the boss is busy or always out. Okay. Very important. Notice when we got down to the end of the internal audit process, we ended up talking about something called internal checks. And of course, it's almost common sense in some instances, but not all of them, that these checks have very specific purposes. Okay? Primarily to reduce the occurrence of what? Anyone? Why do you think we check stuff? What are we trying to reduce? Primarily, two things. Anybody remembers? Internal checks are done to reduce two things. One word starts with F and the other one starts with E.
Frauds and errors.
Therefore,
Yes, frauds and errors. Okay, that's always the big deal. Frauds and errors. Does anybody remember the difference between the two? By definition.
One is misappropriation by oh, everything. One is by negligence, and the other one is by intent. Fraud is intent, and errors are by negligence.
Absolutely, absolutely. Very important stuff. Even if you don't care, remember everything that you do. Some of the things like that are important to remember so that you continue in whatever field of work, you'll be able to communicate on this very important level. That's the whole point.
Mhm.
So frauds and errors are one of the primary objectives for internal checks to make sure that staff members not up to no good or they're not making unnecessary and tumultuous amounts of errors. Okay? These checks are designed to make it more difficult for too many errors to occur and too many frauds. And even if frauds are committed, if you're checking on a regular basis, chances are you'll be able to find the fraud sooner than if you don't check often enough. There's also a problem that comes up when these internal checks are being done, and that has to do with checking for collusion. Anybody knows what collusion is? Collusion. When we collude, what are we doing?
That's when two or more persons are involved in fraud.
Yeah, two or more people agree to be involved in fraud or any other wrongdoing for that matter. Okay, so typically, if two persons are designed to open up the night deposit bag, that's set up that way so that one person will not make the decision to get greedy and try to run off with some people's money for whatever reason. And so that's why two people are there in an effort to reduce that possibility. And that works very well because they watch each other until they somehow get together after opening a whole bunch of night deposit buys for some period of time and decide, well, they put us here to watch each other. Why don't we get together and make us some money? By the time that happens, then we now moved away into an area called collusion. And when persons collude, it makes it very difficult to find errors and frauds, particularly fraud, sorry. Okay, because now nobody's telling on nobody. And so if you're not keen or lucky, you may not ever detect the fraud when there's collusion. Okay? Checks are also done to put pressure on staff members. What kind of pressure do we mean? Well, the fact that somebody will be coming in to check at any time should be enough pressure. You don't know when they're going to come. You don't know the extent to which the checks will be done, and you don't know how far the internal audit people will go with the checking process. So that way, hopefully, the control there is to encourage people to stay on their P's and Q's and continue to do the right things. Okay. What else? Internal checks. We are told that it also allocates the duties and responsibilities of everyone in the firm. And so we all have our job descriptions, and checking is part of the process of ensuring that people are carrying out their jobs in accordance with their job description. Some people in some organizations start off with one job description before they know it, they're doing 2 or 3 other types of jobs that they were never really officially hired to do. And so this and other responsibilities need to be looked at to make sure that the right people are doing the right jobs in the right places. Okay? So yeah, the audits are not just wasting time, they are making you miserable. These checks are very necessary for the smooth running of the organization. by all means. All right. I think we already talked about the division of labor earlier. Part of the audit check is to make sure that these division of labor protocols are in place. Um, if you collect money, you should not deposit money in the bank. If you deposit money in the bank, you should not be posting to the general ledger and the accounting department, and so on. These general rules about division of labor, segregation of duties are very important rules for internal control purposes. And again, all of these things and much, much more, internal auditors will be checking. And certainly when external audits come in, they check the internal auditors' work to see to what extent their checks have been. If the checks were very extensive, then the auditor might do less work in gathering audit evidence. If they find that the internal audits are not frequent enough, not detailed enough, doesn't attack enough areas, then the auditor will can certainly acknowledge the content, but seek to do more of what it needs to do. Give me 1 second, please. I'll be right back. Okay, sorry about that, folks. Sorry about that. Bloody work emergency. I shouldn't have answered that phone. All right, everybody still there?
Yes, sir.
Yep.
Uh-huh.
Yeah, yeah.
Thank you for your patience. At this stage of my life, I shouldn't be answering any work emergencies when the phone ring. I should just hang it up. I leave that stuff for you guys. All right. So, those are some of the key objectives for these internal audit checks. Okay. And everyone in this room, if you haven't been impacted by it yet, you will be. To be aware that these things out there that need to be done are very important. You may want to make recommendations to your firm. You can use this information for all kinds of different things. Okay, and that's the beauty of going through this kind of process and gathering this kind of information. Okay, and then I think we ended our session by talking about why is it a good idea to have these checks in place, that no single person should be doing the same, any number of things. That's a big problem. You have to keep check on the company assets to make sure that people who have access to information are those authorized to have it. You can't have every Tom, Dick, and Harry looking into stuff they're not supposed to look into. And certainly, by the way, does anybody know what physical custody of assets mean? What does that mean? Physical custody of assets, custody of assets. Ever heard that? Anybody?
I've never heard the terminology before.
What do you think it means? Make a guess. Physical custody.
Control of assets.
Okay, that's
Control.
yeah, that's a good definition. So whoever controls it, and literally it means if you have cash, taking physical custody of cash means taking it, locking it up in the vault. Taking physical custody of inventory means making sure that they're locked away under lock and key, that people can't just walk in and grab whatever they want whenever they feel like it. They have to come in with an authorization to get it and then sign for it and date it for that particular day. The quantity and type of stuff that they came in to get. That's how we control through physical custody of assets. Okay, so yes. Interestingly enough, one of the other elements or essentials of internal checks has to do with it says all staff who are responsible for assets should take annual leave. Why? All staff who are responsible for assets should take an annual leave for vacation. Why? Why is that a good idea?
To uncover any errors or fraud they may be hiding.
Yeah, folks, woe be unto you if every year Susie says, I don't need vacation. I love working. No, I know this is third year in a row. I sleep when I go home, or whatever the reason is. I don't need a vacation. That's probably not a good idea. Nobody's saying that QC is up to no good, but she might be. Okay. And so when people take leave, it gives the company an opportunity to have somebody else go and do the job. And perhaps if somebody's doing stuff they shouldn't be doing, whatever it is, doesn't have to be such series of steps in fraud, might be some other operational things that they're doing incorrectly or communicating incorrectly. And so while they're off, the new person doing that job will discover these things and correct them in one form or another. Okay, which is why the two important reasons for people going on vacation is one, to rest, and two, so that somebody else can get in there and do the work and see if there are any things that need to be resolved along the way. Always a good idea. Mechanical devices to avoid the misappropriation of cash. What does that mean? Anybody knows? Companies should use introduce or use mechanical devices to prevent the misappropriation of cash. What do you think we mean by mechanical devices? What would be an example of that? If you go into a business establishment What mechanical device might they be using to control cash?
You mean stuff like a cash register or
Yeah,
Computers,
a cash register and somebody said something else other than the cash register.
computers,
Yeah, the computer, the information goes directly in. So, yeah, the cash register is the primary device, and the computer is considered oftentimes the secondary device for getting the transaction through after it's processed through the cash register. Now, why is it that the cash register is so important to avoiding misappropriation of cash in particular? Anyone? Why is the cash register such a big deal?
because it holds what, the actual physical cash?
Yeah, first of all, it holds the cash and
and it
lock.
record.
Sorry?
I was saying, and it also record.
Yeah, it does. Every time you make a sale, a receipt comes out, and you either receive cash or you give cash. So every time a piece of paper comes out of that machine, that is a receipt, a record of the transactions that took place that day, whether it's a receipt, money coming in, or a disbursement, money going out in the form of change. And of course, at the end of the day, the cash register must be what? Balanced.
Balance.
Yes. So once you print off those pieces of paper in that bloody machine and you come up with a total and you count that cash, what should happen?
It should balance with what you started with.
Yeah, it should balance. The only difference you probably should have is what? The float, right?
Yes.
Yeah. Okay. So the chances of somebody running off with money with the cash register, it's not impossible. People always find some way if they want to, but it makes it very, very difficult. Okay, for sure. All right, so that is the primary mechanical device. And then, of course, once transactions have been processed cash-wise and they've been deposited into the bank, then the paperwork comes in through the accounts department. And so now the secondary custody takes place. Okay, so not in this case to avoid the misappropriation of cash physically, but to avoid any misappropriation or errors with regards to the cash transactions themselves, whether it's a deposit or receipt of cash for payment on account or payment of cash for a liability, or whatever the case might be. Okay, these things are all the things that auditors, internal and external, are always looking for when they come in. So if anybody, any of you are responsible for any of these things, or people now know, yeah, I'm sure you probably already knew that these are the things in your mind to make sure that they're going well. Otherwise, you will have to answer questions, uncomfortable ones. Notice in the final essentials, we also talked about transactions that should go through several routes or hands. Why is it important that transactions go through several hands rather than one? Several hands rather than one.
So there can't be no manipulation of anything?
Yeah, it makes it harder to manipulate when a couple of people are involved. Because if you're planning to do something, it's harder to convince a couple of people than it is to convince yourself. Okay? By all means. All right. What other essentials? Proper records must be maintained. Somebody's mic is open. Okay. Yeah, proper records must be maintained. Why is that? What do we mean by proper records? What do you mean by proper records?
To ensure that stuff are recorded correctly.
Absolutely. Making sure that transactions are recorded accurately. Because any student of accounting or business would know that if transactions are not recorded correctly every single time, then the end result in terms of financial reporting will be inaccurate. And depending on the amount of money involved, that could be a very significant number. Okay? And so why are auditors checking this stuff? Simple, because they know that too many errors and frauds occurring in this area will cause the books to be out of whack. And when the books are out of whack, so will be the financial reporting. And so whoever's using that information, whether they're investors or government or whomever, bankers or whomever, they are likely, if these things are not discovered and corrected, to be reading incorrect reports, which of course for many of them could be quite a misleading situation. Okay, very serious stuff. Okay. Do not make any staff member feel that they are so important to the firm. And too much reliance on any one staff member is never a good idea, according to auditors. What an indecent thing to say, but why is it important? Anyone? Too much reliance on any staff member should be avoided. Why? Why should that be avoided?
Because you wouldn't want to have control of what's going on internally in the hands of one individual. It leaves room for more possible fraud and error.
Absolutely. When you leave it with one person, it opens the door to greater fraud, greater errors. Not only that, if something happens to them, everybody's stuck because they are the only one with the information, etc. So it's always a good idea to have a number of persons available so that the organization will not, or its operations will not come to a standstill if the one person that we rely on too much happens to leave, become sick, or whatever the case might be. Okay, very, very important. A lot of organizations fall into that trap. And I think the final thing we talked about on the internal audit side is that at minimum, whatever organization you run or work for, the following checks should always be done. Much more than these 6 checks, but these 6 checks are key to any kind of financial operation. And so it is suggested that anytime any audits are being done, internal or external, even just by some management people to check on things, these 6 things should be a part of every single audit process. For example, of course, cash and cash sales. Right at the top of the list, cash is the most liquid asset. And if you take your eye off it for 1 minute, somebody might be thinking about swiping it. Okay, in one form or another, cash or cash sales. Deposits through the post and through the night deposit. Again, that's cash. 2 people should open the bag, avoid fraud, hope that they don't collude, and that the whole set of transaction processing goes according to plan. But again, just like other cash transactions, postal and night depository can be subject to all kinds of fraud and misappropriation. And so if you have those kinds of things in your organization, they must be well protected in terms of the process for accessing them, verifying them, and getting the money into the bank or the vault or the till or wherever it's supposed to go. Okay. Remember, when it comes to money, most of us are okay, but there are some folk who just cannot help it, especially if it appears easy to get because of a lack of controls. Okay. What else should we be checking on? If the company has people working for them, I know this is an area that we don't think about much, but any agents and reps that you have working for your company, you need to check them out. Talk to them, find out what they're doing, find out why they're doing it, find out who they report to, find out how much they're paid, check that against the payroll report, all kinds of stuff. Basic checks, you'll be surprised what comes up when you check stuff. And auditors, for one, know this. Okay? Audit your purchases, whatever they are, soap, cars, inventory, whatever the case might be. Audit them to make sure that the vendors are legitimate, that the purchases are approved, that the payments have been made, that the payments have been made to the correct vendors, and the list goes on and on and on. Okay? Check your sales, make sure they're not over, underreported. Very important. Make sure those cash registers balance. But sometimes people find the most ingenious ways to do things, certainly to get away with it. And I think I remembered before, I said before, one of the areas that people sometimes don't check closely enough, sometimes even auditors, is the payroll, the salary schedule, to make sure that everybody on the payroll still works for that company, to make sure that everybody on the payroll is still alive, to make sure that everybody on the payrolls is being paid what the payroll said they're being paid. So you see, none of it is a simple, straightforward process. Okay? So we have to be very, very careful. And again, this is why we have the dual internal, external audit, all this designed for the firm to protect its assets. Okay? All right. So I went back to that for a little bit because the internal control process is so vital to any type of entity, organization, whether you realize it or not. Hopefully you guys, having come through this kind of stuff and getting some information, to go back to your firms with a far greater appreciation for all these things, how they tie in, and what kinds of things you need to be alert for, and to report and to correct. And certainly when your internal and external auditors come in, you're the guys that are supposed to be a little more friendly towards them, quote unquote, because now you understand better the nature of the task that they have with regards to the maintenance and the audit of your firm. That's the beauty of this crazy stuff. All right. So now we go to this other part of auditing that we call what? Someone? The next module. What do we call this part of auditing? Anyone?
Vouching?
Yeah, vouching. That funny word. Anybody ever, anybody
I
ever
didn't
heard
think it was that simple.
I see. You know, it's a more sophisticated word, huh?
Yes.
I know what you mean. Certainly, certainly.
Mhm.
It's like this. Guy sees a girl. This is for Brian and Siobhan, the guys. Guy sees a girl, or maybe girl sees a guy, even. Why not? Doggone 21st century. Girl sees a guy, guy sees a girl. And you're thinking, I should ask that person out for a date. And then you get the nerves like they might say no. And so you agonize over it for a day, a week, a month, 6 months, a year, whatever the madness is, thinking if I ask them, they might say no. And just think, just like the word vouching, like she said, what you have to do is just go for it. See? And say, will you go out with me? And guess what? Brian, what might she say? She might shock you and say,
Yeah.
yeah. And then she's like, what the hell? Okay, so yeah, vouching is one of those funny words like that. It looks crazier than it really is. All right. So what then is this funny word called vouching in the audit world? Okay. Remember, so far we talked about quite a number of interesting facets of audit that we toiled through. We talked about some of the introductory aspects of audit, the principles, definitions, concepts, even the advantages and disadvantages of the audit. Then we talked about the types of errors and frauds and how auditors view them and deal with them when they come into the firm. Then we talked a little bit about, okay, how to plan the audit, how to put the paperwork together, how to put the questions in together, who's going to do it, what kinds of questions will we ask, the whole planning process, so that the audit can go smoothly as possible. And then, of course, after the plan, we talked about the techniques that auditors use, and vouching now, outside of internal controls, is a technique that auditors use in order to get the job done. Okay, so let's see who's going to lead us off this evening. Monique.
Okay, gonna try to read slow this evening.
No, I don't want you to read slow, because if you read slow, then it'll be not you, boring, wouldn't have that excitement. I want you to read exactly the way you normally read. How's that?
That's no problem.
Good. And who don't like it?
Lump it.
Thank you very much. Let's
All
go.
right. Okay, vouching, meaning vouching is the examination of documentary evidence in support of entries to establish arithmetic accuracy. When the auditor checks the entries to the documents, it is called vouching. Vouching is the acid test of the audit. It tests the truth of the transactions recorded in the books of accounts. It examines documentary evidence in order to ascertain the accuracy and authenticity of the entries in the books of accounts. According to Dixie, vouching consists of comparing entries in the books of accounts with documentary evidence in support thereof. According to Joseph Lancaster, it is often thought that vouching consists of the mere examination of the vouchers or documentary evidence with the book entries. This is, however, quite wrong, for vouching comprises such an examination of the ledger entries as will satisfy the auditor. Not only that the entry is supported by the documentary evidence, but that it has been properly made in the books of accounts. Based on the above, vouching means testing the truth of entries appearing in the primary books of accounts, general ledger. It seeks to examine the evidence in support of any transaction or entry that is recorded. The auditor should be satisfied that they are properly maintained, they are supported by all evidence, and they are correctly recorded in the books of accounts.
Now, before Monique goes on, notice vouching is really a very detailed exercise. In other words, if you purchase a particular item or you have a particular transaction, the vouching process looks at the transaction from the beginning of the process all the way to the end, checking all the necessary paperwork and documents along the way to make sure that that transaction was successfully and correctly done. Okay, especially when it comes to big ticket items and medium ticket items. If it's a small ticket item, I won't tell you that the auditor will not vouch it, just to make sure the process is being adhered to. But certainly big ticket items and mid-sized ticket items, they're going to be checking all the, bring me this file, bring me that, because they're going to walk it through and vouch from the beginning to the end. All right, keep going, Monique.
Voucher. Any documentary evidence supporting the entries and the records is called a voucher. Any document which supports the entries in the books of accounts and establishes the arithmetical accuracy is called a voucher. Examples of vouchers: a bill, a receipt, an invoice, goods receipts, notes, salaries, and wages sheets, goods inward and outward register, stores, records, counterfoil of a checkbook, counterfoil of pay-in slip book, bank statement, bank passbook, delivery receipts, agreements, a material requisition slip, copy of a purchase order, minute book, memorandum, and articles of association, partnership deed, trust deed, and prospectus are the examples of vouchers.
Does that satisfy anybody now that vouchers are everywhere and everything in the business and accounting process? And this list is not exhaustive. Any kind of paperwork that is involved in the process of the business process is pretty much a voucher, proof of the transaction actually occurring. All right, keep going.
Importance of vouching ensures genuineness of the transaction. One gets to know the detail of the transaction, helps auditor to know relevance of the transaction, facilitates proper allocation of capital and revenue expenditure, detects frauds and errors, decides authenticity of transactions, ensures proper accounting, ensures compliance with the law, ensures proper disclosure.
Keep going.
Special considerations to be borne in mind by the auditor in the course of vouching. 1, date of the voucher. 2, the name of the party. 3, tick and audit rubber stamps. 4, authorization by the designated persons. 5, revenue stamp. 6, transaction related to the business. 7, revenue versus capital transactions. 8, amounts in words and figures. 9, account headings. 10, no assistance from clients when checking receipts.
Keep going.
11, verify receipted invoices. 12, missing vouchers. 13, important documents. 14, vouching of cash transactions. 15, proper filing. 16, signature of payee. 17, nature of payments. 18, notations in the audit notebook. 19, alterations. 20, voucher control numbers.
Monique, before you go on, I don't know about you guys, but that's a whole bunch of crap going on to make sure that things are going right. And these are really 20 of the key steps in the vouching process, the checking of documentation process. All right. So in other words, if one of you get thrown into an audit department tomorrow, God forbid, even without training, you can come right here and get started with vouching. Okay. So your supervisor, your boss says, I need you to vouch the sales transactions for the month. So that means every day of that month, you have to take the sales reports or slips or receipts or whatever the document is, and you can start at the top. And whatever of the 20 applies, you check them to see if they are accurate and complete. And if you're doing that, you're vouching. And if you're vouching, you're checking the details of transactions. You're not just skimming it. You're not just sampling it. You're checking the details, starting with the date. So if this is 2023 and you pick up a sales report for a receipt or invoice for 2020 during COVID, you know there's a problem, Houston, right away. So you're going to go to the relevant people as the auditor vouching and say, this 2020 sales thing was sitting in the 2023 sales or 2022 sales. How did that happen? And then it's, oh, we're sorry, it was a mistake. Could it have been deliberate? Anyone? Could it have
Yes.
been
It could
deliberate?
have,
Yeah,
yeah,
it
it
could
could
have.
have.
Yeah, by all means. Let's say it was a sale for $1 million and they want sales to be looking good in 2023 or 2022. So you take something from 2020 and you throw it in there thinking that nobody's going to check the date. Because like, who checks the date? Well, people who check dates. And auditors certainly should be date checkers. Maybe the rest of the world is too busy to check a date. But cashiers, like tellers and auditors and people like that need to check dates to make sure that those dates are correct. All right. And so you can go down the list, checking the date, say checking the name, making sure that the name is correct. A lot of times we think like the name is not a big deal. We just skim over it. We see something scratched that it looks like a name. We think that's the right name until something else goes wrong. Then we discovered, Brian, didn't you say you checked this thing? And you're like, yeah, I check it. So why is the name Adolf Hitler here? I said, what is it? I missed that. I should have picked up on Adolf Hitler. That's a funny name. Okay. But truth be told, he didn't check the name section at all. And then, of course, if something goes wrong, then we have a big problem. tick off information that needs to be ticked. There's a list of numbers to verify, hundreds, thousands, millions, billions, verify them. Take them one by one, make sure that they correspond with the relevant documentation. You'll be surprised to know what you'll find if you're vouching carefully. All kinds of strange things come up when you are vouching. Because vouching is not taking a cursory look, like a brief, quick look. No, no, no. Vouching doesn't work that way. Vouching is that animal that checks all the details, sometimes one by the auditor, depending on the amount of money and transactions that are involved. Okay? And so you can see it's a long list of things to check. And even if you're a new auditor, if you just use this list alone, print this and say, okay, fine, I'll start with this. I don't know what the hell else going on, but I'm starting with vouching. And you'll be shocked to find out some things right away, even as a newbie, about what's going on. All right, keep going, Monique. Objectives.
Objectives of vouching. 1, to ensure that all the transactions are properly recorded in the books of accounts. 2, to see that proper evidence supports all the entries of the transaction. 3, to make sure that fraudulent transactions are not recorded in the books of accounts. 4, to see that all transactions relating to the business are recorded in the books of accounts. And 5, to see that all transactions are properly authenticated by a responsible person.
Keep going.
Auditing techniques. 1, to an auditor, auditing techniques are the working tools used and applied for identification and examination of evidence which have been traced by audit procedures. 2, the dictionary defines the word technique as the method of performance or execution, procedure, method of conducting an affair, and course of action taken or an act performed. While we can state that an all-inclusive list of techniques can be outlined, even with the addition of new or improved methods or techniques, an all-inclusive list of procedures is difficult to prepare. Techniques are rigid and limited, but procedures can be many and vary depending on the audit objectives. An all-inclusive list of the audit procedures cannot be prepared as these change based on the audit objectives, but the following list can be used for audit techniques. Auditing procedures are methods of applying auditing techniques to phases of a particular audit. The audit procedures adopted in different engagements result from the judicious of application of the available audit techniques. Audit procedure is concerned with the general assertions like existence or occurrence, rights and obligations, completeness, valuation or allocation, and presentation and disclosure that may be made regarding an account. Audit techniques are concerned with the examination of evidence traced by audit procedures.
All right, thank you very much, Monique, for that. And so, yeah, all of a sudden, this vouching has opened up a whole new world. We go from the general to the very specific part of audits, from our conceptual discussions about the history and why auditing is important and who's responsible for conducting them and in what capacity. And now we're into the vouching, which takes us into the nitty-gritty of auditing. And we see straight away that vouching takes us into the paperwork, the checking, and then by going into the paperwork and checking, we have certain techniques that we use in order to make us more successful with the vouching process. And vouching itself is considered a major audit technique to determine whether or not all the steps have been taken to make sure that a transaction is complete and accurate. Okay, big time stuff. Notice the last paragraph she mentioned that within audit vouching, we have audit techniques, and within audit techniques, we have audit procedures. They're all designed to detect errors and fraud, to prevent errors and frauds, and to discover any activity that's going on within the organization that is inconsistent with its policies and procedures. Okay. And so while techniques will take us into the detail review of the paperwork right down to the very last bit of transaction activity. Audit procedures, on the other hand, tend to be more general in perspective and raises the overall concerns. So the techniques does the investigation, the procedures that deals with the overall concerns of the audit. And so in this situation here, we are told that the audit procedures are primarily concerned with what assertions are being made by management. For example, is management saying that all the financial records are correct? Well, the auditor's job is to come in and see if that assertion is correct. Is management saying that all the steps that are taken to account for transactions from start to finish are being done according to policy? Okay, if that's your assertion, fine. The auditor's job is to come in to see if your assertion or your output about how the operation is working is actually working that way. Okay? And so procedures will look at these kinds of things. Okay, it will look at, does the company have the proper rights and obligations with regards to assets and liabilities? All the assets properly valued. Okay, is depreciation being done correctly? What about the presentation and disclosure of information? Are you putting everything in the financial statements, Mr. CEO and board, that is supposed to be there? Are you putting all the correct numbers? Following all the correct generally accepted accounting procedures? All these kinds of things are necessary if the audit is going to be considered true and fair. Remember that expression? We're back to that again. All right. Okay, thank you, Monique, for that. Getting us off to a great start. Okay, let's see who's Shaniqua.
Yes,
Okay, Shanika, principal auditing procedure.
okay,
Techniques, the voucher technique, and we look at some procedures now.
okay. Principal auditing procedures. An all-inclusive list of audit procedures is difficult to prepare. Judgment and experience remain the basis for the determination of the type and extent of audit procedures. The following may be cited as the principal audit procedures. 1. Reviewing, testing, and evaluating the internal accounting controls relating to inventories, purchases, payroll, sales invoice preparation, stock valuation, depreciation, accounting and analysis, and the routing of invoices. 2. Inspecting, counting, and calculating assets, including cash, stocks, investments, plant and equipment, furniture, inventory, and obtaining confirmation regarding the validity of debtor and creditor balances. 3. Obtaining proof of accuracy. A copy of final inventory listing can be obtained and is clerical accuracy checked and tested. Obtaining the earnings, records of employees, and checking the same for accuracy with the original appointment letters, appropriation of profit, and the board's resolution.
Before she goes on, Shaniqua, notice in these procedures, with regards to employee records, this is an area that sometimes even the best of auditors either do not look into at all for some strange reason, or when they look into it very cursory, like briefly. And it's interesting that in this example, you guys are being told that when one of the important procedures of the audit is to not only test for accuracy of the payroll, but to ensure that you look at the original appointment letters for each staff member if necessary. Why? What? Who the heck goes to, like, let me see the original job offer letter? Why?
To confirm the appointment of the employee. and that they really exist, maybe.
Yeah.
Ensure the, oh, I was going to say, make sure they're in the right pay scale.
Yeah. Make,
Hmm.
first of all, make sure they exist at all. And secondly, make sure they're in the right pay scale. Because remember,
Okay.
if somebody knows somebody, they can hire you in the letter at what? $40,000 a year, but on the payroll itself, it might be what? 60,000.
Hmm.
And since nobody checks the original offer letter anymore, goes to the bottom of the employee's file. The only thing sitting at the top are stinky reprimands for this or that. Warning letters, and that's the stuff that's at the top. But original employment letters, offers, they're like somewhere at the bottom. Who checks that? Okay.
Hmm.
So a keen auditor would want to do some random checks. Remember that? Random. What's another word for random? It's the S word we talked about.
Spontaneous? No?
Close. Spontaneous is part of it, but spontaneous comes in the front of the word I'm looking for. Samples. Okay.
Oh, something.
You may not want to look at every original job letter, that depending on how many employees, but it's a small number, fine, you can do all. But if it's a fairly large organization, then you take a sample, maybe persons with income over $50,000, you check them. Some income over 100,000, and as you go up the ladder, you look at more. Okay, because those are the areas where strange things happen as you get higher and higher in the organization. Okay? Fascinating. All right, Shaniqua, keep going. Procedures.
Mhm. Number 4, reconciling, comparing, and confirming. Sales invoices may be reconciled with the total charges to customers. The reconciliation between the cost account records and the books of financial accounts is an example. The bank reconciliation statement provides a good measure of confirmation of cash transactions. Inventory can be compared and confirmed to inventory documents, and minutes of the board of directors can be checked for pledges or assignments. 5, observation and inquiry about any excess, slow-moving, or obsolete inventory. 6, accounting of all pre-numbered inventory tags before and after the physical stock taking. 7, verification of the evidence relating to the ownership of assets and the existence of assets and liabilities as a part of auditing practices and procedures is the principal duty of the auditor before he certifies that the assets and liabilities that appear in the balance sheet exhibit a true and fair view of the state of affairs of the business.
Imagine that there's some companies with assets and liabilities sitting on their financial statements that do not actually even exist. And if the
Wow.
auditor does not check it, he would never know. So somebody throws an asset land, 3 million. But if you don't check the mortgage document to see if the land really exists, and if you see a mortgage document, you have to check to see if it's in the name of the company that you are auditing. That document might be there, but in the name of another company, not the one you're auditing. Yet the $3 million land asset is sitting on the balance sheet of that company you're auditing.
Mm.
Yeah, spooky as hell. So these things, see, this thing called auditing, it is much more than we hear about it in practice. Because most of us, unless we are auditors, like it just kind of goes over our head. Like, oh, well, I have too many others. Pass me that entry, I need to get out of here, kind of thing. Because we're busy with our normal day to day. But for you guys who stop to take a moment and say, no, I'm going to spend a couple of bucks and go through that pain and suffering of doing that class. Suddenly now, it is the hope that you can easily already see the huge benefits of having this kind of information. And later on, as your careers change and improve and diversify, you'll discover that this information will be there to assist you in one form or another long after you have graduated from this course. Therein lies the beauty of information such as this. All right, keep going, Shaniqua.
Test
check.
checking. Okay, meaning carrying out detailed checks of each transaction of a large business can be time consuming for the auditor. In auditing the accounts of a business, every single transaction is not usually checked by the auditor. Instead, a representative number of entries of each category are selected and checked, and if they are found to be correct, the remaining entries are deemed to be correct.
Sorry,
This
what
is
does-
known.
sorry, Shaniqua.
Mhm.
Does anybody know what that means? They can't check all of them, so they check a sample representative of them, and if the sample appears is correct, then they simply make assumption that the rest of them are correct.
Or
Yeah, now that's how test checking works. That's a hell of an assumption to make. But if the sample is a good enough sample, a good
Oh.
size sample, and they basically turn out to be correct, yeah, you can pretty much presume that the rest of that category is probably correct in most respects. Unless you do every last one, you can never be 100% sure. But the test checking of the representative or sample is designed to come as close as possible, especially when you're auditing medium and large firms. Okay? There are just too many thousands of transactions per day to go through every single one. It would be total madness. You'd never finish. All right, keep going, Shaniqua.
okay. This is known as test checking. In organizations where internal checks and controls are satisfactory, the auditor need not carry out detailed checking. He may adopt test checking, a system of sampling employed by the auditor for the purpose of reducing the volume of detailed checking involved in the audit. If when test checking, he discovers that the records checked by him are correct, then no further detailed checking need be carried out. Test checking versus statistical sampling. The selection of items for checking can be done in two ways: judgment, one, and two, statistical sampling. When the judgment method is applied, this method of checking is called test checking. When sampling techniques are applied, it is called statistical sampling. When adopting the test check, the auditor must take the following precautions. Number one, entry selected for test checking must be representative of all transactions. Two, the selection of the items should be random. Three, it cannot be adopted in lieu of vouching the cash book. Four, clients or staff should not be aware of the entry selected for test checking. Five, periods selected for test checking should differ from book to book and year to year. Six, he should not adopt test checking where the law requires a thorough audit.
Mhm.
Seven, a number of entries of the first and last month of the year must be checked thoroughly. 8, tests should be so devised that a sizable portion of the work done by each employee is checked. 9, control accounts or impersonal ledgers should not be subject to test checking. 10, auditors should select the tests independently without regard to suggestions from the client's staff. 11, bank statements and entries for cash withdrawal and cash deposits should be checked in full. The extent of the test checking will depend upon the judgment and discretion of the auditor, but it must be remembered that time unnecessarily spent in routine checking is a waste of resources. Caution must also be taken to ensure that the test checking does not become automatic and unrepresentative. Test checking will be of no use unless the representative items selected for checking are chosen with great intelligence and imagination.
Wow, let's take a pin for a moment, Shaniqua. Notice we have a whole lot of suggestions with regards to the test checking process. Remember, test checking is taking a representative sample of the whole category, whether it's sale or purchases or expenses or whatever it is you're checking. And then you test those to make sure that you find that they are basically correct, and you say the rest of them are basically correct. You find too many errors and you say, wait a minute, too many errors in this sample, let me widen the sample. So you test, you get a bigger sample, and you keep testing it that way until you're satisfied that the majority of transactions are done correctly. If you consistently see errors throughout the process, depending on the size of the firm, you may have to pretty much randomly check them a greater majority. If it's a huge firm, you're gonna have to take your chances as an auditor, and this is what we mean by using your judgment. Right? If you find more to be correct than less, then you say, fine, I can live with that. If you find more to be incorrect, you say, I'm still not comfortable, but in a way, I'm gonna be able to check 3 million transactions, and so the representative amount that I choose in my judgment will have to be sufficient for my conclusion, despite what the actual outcome might be. And so there's a little bit of what we call audit risk, by the way, as you can see, involved in this process, because it is not scientific in nature. It is based on the experience of the auditor, him or herself. And so this judgment call is made with regards to what should be test checked and to what extent. Huge responsibility on the, and usually this is done by the senior auditor, obviously, who is purported to have a little more insight, a little more experience, and definitely more qualified than a younger auditor or someone new to the business for this kind of job. So, yeah, it's a long list of things. For example, look at number 3 again. It cannot be adopted, meaning test checking, in lieu of vouching the cash book. Now, why shouldn't we sample the cash book anyway? What should we do with the cash book? Why shouldn't we sample it or vouch it or test it? The cash book. Well, cash is the most, what, liquid asset? What do I mean by liquid? It's the one that is easiest to steal.
Accessible.
Yeah, cash is the easiest asset to steal if you don't protect it constantly. Okay, and so when auditor comes in, they don't want to test check cash. In fact, it's not even recommended. Okay, cash basically should always be checked in what? Anyone?
Detail.
Yeah, in detail. Exactly. In detail. So if the company has $1 billion, well, suppose the company has $1 billion, well, you should not be counting $1 billion. Because if the company has $1 billion, where should it be?
Should be in his bank account.
It should be in the bank account. So you're not counting $1 billion, but you are going to that bank account, aren't you?
Yes.
You're not checking that. You're checking to ensure that the $1 billion is there in full. Okay. The other thing that's interesting is a lot of times person's balance sheet will show cash amount of X. And when the auditors check the bank account balance is something else. Like, how the hell could the financial statement have a balance of X as of the 31st of December? And then when you go to the bank statement as of the 31st of September, the bank statement is completely different. Well, we know what that is. That is called a red flag. And auditors are always looking for red flags to see when people are not doing the jobs they're supposed to be doing. Notice the period that you select for this test checking or representative sampling testing should not be made known to your staff. to the entity staff. Why? Why shouldn't you tell the staff what's wrong?
I could correct some
Yeah,
things that they've been doing.
yeah. Okay, who said that?
I did.
Shanique,
Nico.
yeah, Shanika smiled for a reason because Shanika probably knows, yeah, some folks try all kind of crazy stuff.
Yeah.
Yeah, you cannot tell people in advance all the time because they have time now to go fix stuff, pass the entry to cover that entry, borrow the money back in petty cash, whatever it is, back in cash, the teller's till, whatever the situation is. Once people get information ahead of time, they can go and fix stuff for the most part. That's why we have call surprise audits. These
Yep.
things, because once that happens, you're stuck. If your house is not in order, dog eat your lunch. Back in the day when I was a young loan officer back in Nova Scotia, sometimes we'd have surprise auditors from the auditors in Canada. They would come in and seal everything, and you have to stop doing everything. Don't talk, don't sit, don't stand, don't nothing. Nobody moves, nobody gets hurt.
Okay.
All right. And suffice it to say, there's always at least one or two persons who get caught because they didn't expect for those guys to come. Okay. All right, keep going.
Oh, question for
Yes.
number 6.
Yeah.
Where it says he should not adopt test checking where the law requires a thorough audit. So what type of checking would be used for a thorough audit?
Man, how nice. I was hoping somebody would be bold enough to address that number 6. Statutory audits are basically audits that are required by the law. Okay, these audits are required by an act of parliament that makes it mandatory for audits to be conducted. Now, statutory audits are usually for reporting to financial institutions where you borrow money and to the government where you pay taxes and all this kind of stuff. And so if you are preparing financial statements under statutory law, the auditor coming in must also audit those statements pretty much, quote unquote, 100%. Okay.
Okay.
And that's the reason why we are told that test checking, we should not adopt test checking where the law requires statutory audit. Okay, by all means,
Okay.
sure that, yeah, we capture pretty much all we need to capture and not run into trouble with the government specifically. All right, good question.
Okay. All right.
Going.
So, okay. Advantages of test checks. Number 1, volume of work is considerably reduced. Number 2, there's a saving in time, cost, and energy. 3, the extra time available can be used to focus on areas of importance. 4, if done carefully, test checking can be quite effective. Disadvantages of test checks. Number 1, the auditor is always concerned about whether he has missed important items or that errors have remained undetected while test checking. 2, where the client's staff is aware that the auditor resorts to test checking, the staff may become careless. Auditor's liability. Test checking may result in the auditor overlooking errors and frauds and being held liable for the oversight. The auditor must carefully select the items for test checking to ensure, on the whole, that the accounts show a true and fair view of the profit loss in the case of the profit and loss account and of the state of affairs of the organization in the case of the balance sheet. Surprise checks. To avoid audit procedures from becoming routine, mechanical, and predictable, surprise checks are desirable. Surprise checks involve visits by the auditor to the client's office, factory, without prior notice. The element of surprise should be in respect of time and scope. Items checked during surprise checks are selected without prior notice to the client's staff. Such checks are highly effective for the verification of cash, stocks, investments, and the verification of books of prime entry. It helps in ascertaining whether the system of internal control is operating efficiently and thus prevent and detect errors and frauds.
Thank you very much, Shaniqua. Great job, great job. And so it's fitting after all the testing conversation and what should be tested and not tested, and what procedures we should consider in terms of conducting the audit after we consider the techniques that we're going to use in the vouching procedures and the judgment call. See, a lot of things go on. That's why, especially external auditors, some of them get paid the big bucks because they have a huge responsibility. Not all auditors get paid the big bucks. You have to move up the line to get the big bucks. But you know, some of them get paid pretty well. But you can see they have a huge job ahead of them whenever they walk into an organization. And of course, it's fitting that we end this part of the discussion with surprise checks that we were talking about. And of course, the reason is the same. And we are given some categories where definitely surprise checks are a good thing, starting with cash, starting with investments, and starting with inventory. We've also added what we call the books of prime entry, which are the key financial statement records sitting in the balance sheet and the income statement, making sure that generally speaking, what is going to those accounts are actually being posted and they're represented by documents that are real, not fake. But sometimes people fake transactions, use fake documents, and do all kinds of crazy stuff. That's the whole point. Imagine if we didn't have any audits at all. It'd be a nightmare. All right, great stuff. Thank you, Shaniqua. Let's move over to one of your other colleagues now. Let's see. Javon looks like he is ready to go. Javon?
Okay. All right. Use of ticks.
Javon.
Hello?
Okay, great. I can hear it. It sounded like the NWCA was on.
Use of ticks. Ticks are used to keep a control on the work done by the auditor. Use of ticks should be done with great care while conducting an audit. Firstly, the cut of the tick should be determined so that it's unique and will not be confused with that of the client, staff, or internal auditors. Secondly, the types of ticks to be used should be selected. The ticks should be placed at the right places so that the data remains legible and records do not become shabby. Care should be taken.
Yeah, I was just gonna say it's interesting. Like this thing goes all the way down to the color of the ticks.
Yeah, this is funny.
But okay, let's see what that's all about. Let's come on, heavy test checking, surprise audits, and I say, hey, don't forget the color of the ticks are important. Well, let's see. Keep going.
Care should be taken to see that the use of different ticks does not become known to the client staff. Auditing in depth. Taylor and Perry have defined auditing in depth as the examination of the system, which includes the tracing of certain transactions from their origin to their conclusion, investigating at each stage the records created and their authorization. Audit in depth does not mean 100% checking. It is a detailed examination of the selected transactions from the beginning to the end. Thus, it is used along with test checking. For example, if the auditor has decided to check 25% of purchase transactions, these transactions should be checked in depth. The auditor should check the purchase requisition, tenders, purchase orders, purchase bills, goods received, notes, inspection note, purchase journal, stock register, bin card, and so on. Thus, the auditor should check the purchase transaction right from the beginning to the end. This enables him to evaluate the accounting system and internal controls.
Yes.
Audit of income, cash sales. The cash sales register should be fully checked with the carbon copies of the cash sales. Particular attention should be given to the first and last month of the accounting year. A summary of daily cash should be checked. The auditor should be more careful where cash memos are issued, even where cash is not received. A certain representative item should be subject to vouching in depth to get an idea about reliability of internal control. Cashier and related summaries should be compared. Dates of cash sale bills and the date on which the receipt are recorded in the cash book must be the same. If the dates differ, the transaction should be investigated. Which cash sales bills are canceled? All the copies, including original copy, duly canceled, should be kept in record. Where it is a policy of the company to allow a discount, it should be determined that the policy is followed. If the sales are made by the salesman, their statement should be verified and reconciliation should be made with the record of cash received. Verify the entries in the cash book and the corresponding effect in the sales account in the ledger.
Before he goes on, I hope you guys can see straight away that this whole thing surrounding cash, you have to, it's being swarmed by every aspect of the audit. Nothing is taken for granted. Nothing is left unturned. You have enough trouble trying to audit non-cash assets and liabilities. So imagine something as liquid as cash that can be swiped and moved and defrauded so easily, depending on the environment, that you have to keep close tabs on them, from whether it's the daily operation, and certainly when auditors come in, as you can see, they tear cash issues apart. They are relentless. They check cash transactions from every angle. They check, at least they should, check all the transactions connected there too. And that's how serious it is. Because if you miss a loop, it's not like your belt. Missing a loop in the process can cost the company a whole lot of money. Okay? All right, keep going, Javon.
All right. Sales approval. Document to be seen. Aspect to be verified in auditor's duties. Examine the sale or return date book for the method of accounting. Check actual movement of goods from dispatch register / goods outward book. Note that the period of approval in the case of different goods / customers. Verify whether goods returned have been properly reversed in the day book. Order book or confirmation book. Examine this register to verify sale confirmed by customers and goods held by customers at their end as sale or return stock. Sales register. Ensure that sales have been recognized whenever A, approval is received from the party, or B, goods are appropriated by the party, or C, period of approval has expired and goods have not been returned. Stock registers and statements. Ensure that closing stock includes goods lying with customers in respect of which period of approval has not expired. Ensure that goods validity returned by customers are duly accounted in stock. Consignment sales. Consignment agreement. Ascertain and note that following terms and conditions: commission due, manner of payment adjustment, etc. Risk of bad debts. In the case of lost commissions, co-signee has to bear the risk of bad debts. Otherwise, bad debts are borne by the co-signer. Reimbursement of co-signment expenses, eligible expenses, extent of reimbursement. Goods outward book. Verify goods dispatched by reference to the pro forma invoice, consignment day book, goods outward book, transport documents, acknowledgement of the goods by the co-signee and accounts sales. Stock registers. Ensure that the stock line with co-signee at the year end is taken in the balance sheet at cost on a consistent basis and credited to the co-signment account to arrive at the result for co-signment transactions. Ensure that no profit is taken for the profit on goods remaining in the hands of the co-signee. Account sales. Verify whether co-signment sales are accounted by credited co-signment account and debiting the co-signee's account. See whether the summary of transactions reported, i.e. sales made, expenses incurred, commission due, remittances made, balance of stock, and amount due from / to either party is properly disclosed in the general ledger. Form F. For goods sold through agents in the sales for goods sold through agents in the course of interstate trade or commerce. Verify whether Form F has been obtained under the CST Act. Consignment account. When the goods are consignment above cost, ensure the necessary adjustments to remove the loading are made at the end of the year. Verify whether necessary adjustments are made at the year and in respect of unsold goods, commission and expenses incurred by the consignee. Confirmation. Obtain confirmation of the account balance from the consignee.
Thank you very much, Siobhan, for that. Bunch of confusing gobbledygook. But again, now let me just give you guys a hint. This particular section here, we'll be talking about the documentation and other things that auditors are going to be looking at when they come into a particular type of business. Because remember, they're going to be auditing all kinds of business, financial services, like where some of you work, retailers, wholesalers, manufacturers, and all this kind of stuff. Businesses of all kinds. And so the audit plan will be different depending on the type of business they audit, but the steps and procedures will have a certain consistency to them. Okay, and so for this section, beginning with sales approval, I would, if I ask a test question on this, I don't expect you guys to remember all that crazy stuff going down the line that Javon just read. I just expect for you, and that's why I kind of let him go through the process. So you could just kind of hear it and let it bounce up your ears and go to hell somewhere. But basically, I want you to be aware of all the kinds of details, areas that auditors look into in order to satisfy themselves that at the end of the day, when they make their opinion about true and fair, that they've gone through the ropes in conducting their audit plan in accordance with the techniques and processes and procedures that they have established. And again, these are just a list of some of the things that auditors do in terms of what they look at. Okay, anywhere from the sales book to the order book, to the sales register, to the stock register, and any goods that are on consignment. Now, does anybody know what consignment is? I don't mind if you Google it. Consignment.
It's similar to like if you have an account with the business, like Thompson Trading.
Yeah, that could be on a consignment. Again, it depends on the nature of the business. A typical consignment is when you take possession of goods or services or some asset from some supplier, and you say to them, I will sell these for you, but you have to pay me a commission on each sale. I will not ever own these goods. You will always own them. And so you're just sending them to me on consignment, meaning I'm just there to sell them and make a commission. And you, as the provider of those goods, will get whatever the sales price of those items are. And that's how consignments work. Generally, whatever you don't sell, you return because you never really own the assets that you're selling. So yes. Right. And so if you understand that auditors look into these kinds of records and look into consignment of deals to make sure that all the information is correct, then you can pretty much answer my question from this area, should I ask one? So if you can't remember all that crazy explanation on type of documentation, etc., that's okay. I won't ask you to plow through those details per se, just that you know what the documents are and that basically they have to be explored and checked as part of the audit responsibility. That's what I want you to know primarily about that section. Okay. All right. So just to even things up a little bit, Javon, great job. Let's see if your colleague is in the room. Not Javon, yeah, is in the room. Brian. Brian says, man, I'm not in the room.
Yeah, I'm here.
He's in the room. Okay, Brian. Roll down To the bottom of page 12, where it says sales return. You see that?
Yeah, I see that.
Yeah. Before Brian begins, does anybody know what a sales return is?
Return on the sale.
Yeah, meaning? I like that. It's a sales return. Sales. That's cool. That's not incorrect, but what do you mean? Well, you're absolutely right. But what exactly is that? What has to happen for that to be real? Anyone? Somebody can, you
Goods
can
purchase,
The return of goods?
goods purchase,
the return of goods that you did what?
the return of goods that were previously purchased,
Yeah, that's
but
it.
then. Mhm.
Yeah, the return of goods that you previously purchased. That's a sales return. Okay. I don't know about Bahamians. I don't know if Bahamians do a lot of returns, but certainly in the United States, it's a regular practice. And if when Americans return something, if you don't take it back, they will badmouth you. They will tell you everything you can imagine. They will tell you they're not coming back to your store, whatever, because they all pretty much expect that you should return it. I mean, you do have the ability to return it. So sales return is a very big part of the business process in many countries. Okay, do we take stuff back in Nassau? Like if we don't want it or it's broken or something, do we take it back? Do we?
Sometimes.
Sometimes. What about the stores? Are they happy to see you when you come to take something back?
No, not at all.
No.
They try everything because they don't want any sales returns. They try everything in their power to cause you not to leave it. Okay? Because the sales return means that what do they have to do? Put the item back into stock and give you the money back. And for most entities that are selling stuff, that stinks. That is their worst nightmare. They don't want to take anything back and give the money back, ever, if they can help it. Okay? So don't be surprised if you run into resistance. All right, Brian, sales returns.
Sales return. Check the total of sales return journal and find the amount recorded in the profit and loss account. Check every item for sales return with the credit note sent to the customer. Check the entry in the gatekeeper record for return inward movement of goods and check for internal control. Verify the entry in stock register. Compare the extent of earlier year sales and return with that of the current year. The sales return in the beginning of the year and at the end of the year should be carefully scrutinized. Inquiry should be made if there is wide gap between the original transaction and the return of goods. If the goods are returned for unacceptable quality, inquire about the steps taken after return of the goods and verify the documentation.
In case you guys are wondering, what's all of this? What's the big deal? All these bloody steps just to check a return item. Well, for the person returning it, it is simply a return item. They bring it back. They hope to get their money back, and the company hopes that all it has to do is put the item back in stock, all things being equal. It's supposed to be simple, but not to the auditor, as you can see. The auditor checks all kinds of angles when there's a sales return. And the reason for that is people are always using methodologies to manipulate the system, the process, the procedures. So if the auditor is not checking the sales returns, they may find out that the numbers are incorrect, the discount amount is incorrect, all kinds of things are incorrect. Okay? Check it at the beginning and end of the year, because if you don't, people change the numbers to reflect them for them to be what they want them to be. So you have to check the beginning numbers, the ending numbers, all kinds of little people, little bits and pieces, just so one little itsy bitsy set of sales returns. But the reason is, sales returns can be easily manipulated, and depending on the amount involved, the company could find itself out of quite a bit of money. Okay. All right, keep going.
Recovery of bad debts with North. Ascertain from the trial balance the amount under consideration, and it should be taken to the profit and loss account. Number two, check the entry passed for the bad debts written off and its authorization. Three, if the amount is received from a party under liquidation through his liquidator, official receiver, check the letter from the person and check the amount which is received along with the year in which the original debt was written off.
All right,
Four,
keep going.
okay. Four, trace the amounts in the bank statement. Five, check the correspondence with the party and with the official receiver liquidator.
In other words, do not take anything for granted if you're an auditor. All right. Even when you're checking the company's bad debts, anybody knows what bad debts are? What are bad debts? If you had a personal bad debt, what does that mean?
You don't expect payment?
Well, yeah, from the buying side, once an account becomes a bad debt, they don't expect payment anymore. Every now and then, the person might come back, like after they get married and have a conscience, become a priest or whatever, say, I'm sorry, I owe you some money and pay you. But typically, once an account gets a bad debt, that's why we call it bad debt, because it went bad. The loan or the debt went bad. And so at some point, the lender of those funds will have to write it off the books, because after a couple of years, they're satisfied, especially after 7 years, the statutory period, they're satisfied that the person is not going to be found. And so they have to write it off. But even in writing off bad debts, it's important to check, from an auditor's perspective, all the paperwork that would connect with the write-off. Make sure even that the amount being written off is the correct amount, that is not lower or higher. Imagine that, even right down to the bad debt being written off. Still have to check the details involved with that process, the depreciation calculation, the accumulated depreciation, make sure the entry is balanced. If the person comes in and actually says, when I have a change of heart and pay, I'm here to pay my balance. Don't take the money and say we already written it off. I might as well keep this money. This company owes me money anyway. Not at all. You still have to process that payment through the bad debt process. And auditors is always looking for these dark areas, because people and potential fraudsters lie, especially if they understand the process a little bit. It makes it easier for them, okay, to deal. All right, keep going.
A rental receipts. One, check the details of the agreement, including the amount and terms. Two, from the original documents, check the rates, period, signed payments method. Three, check the outstanding rent from last year and find out which of the receipts are for last year and how much still remains outstanding. Four, check the entries in the cash with pay in slips and the receipts issued. Five, check the outstanding rent at the end of the year and see that provisions have been made for the same. Next year records may be verified to find the receipt of the same.
Okay.
And interest and dividends. One, first check the income statement in the current year's profit and loss account. Two, ascertain the amount received on accounts last year and find the outstanding receivables balance. Three, from the cash book, vouch the entries in income received. Four, checks the tax deductions at source, TDS, calculation, and verify the effects given in the ledger. 5. Compare the income received in total with that of last year and inquire about any significant variations.
Hmm.
6. Get a list of investments and check whether the income on all the securities and investments have been received. If any securities are pledged with banks, get a certificate from the bank. 7. Assets, ascertain the income of the year still to be received and check whether provisions have been made for the same. 8. In cases where interest is received, check the calculations.
Huh.
9. From interest from banks, verify the entry in the bank statement. For fixed deposits, check whether any FD has matured or any FD were recently established.
Now, stick a pin. Let's back up a little bit. Notice we're talking about auditing different aspects of the firm. Earlier, we started off way back with the recovery of bad debt and checking the process to make sure the correct depreciation. Because remember, whether you're aware of it or not, if you're not familiar with accounting, depreciation is a figure that is based on judgment and assumptions, and that could be manipulated if somebody wants to behave fraudulently and misrepresent the numbers in the financial statements. Called cooking the books. Anybody ever heard that? Cooking the books?
Say that again.
Yes.
Cooking?
Cooking the books in accounting. Probably not.
Yes,
Yes?
yeah.
What did you hear about cooking the books?
Cooking the books is similar to like window dressing.
Yeah, meaning?
You make it appear a way that it's not.
Yeah, putting stuff in the financial statements that never even occurred. Sales of 10 million, so that the profits can look great and the bonus can be great. And then if you actually check the paperwork, you find sales are about 4 million. See? That kind of stupid stuff. And believe it or not, major corporate CEOs and others actually do this foolishness. They've been caught many times. All right, trying to inflate the total sales position so that they can inflate the profit position so that they can get bigger bonuses because they have performed so well. And sometimes it's not the truth. They are lying. And this is why auditors are lying deliberately too, and not by any small amounts either. Okay? When these guys are going on the rampage to steal, they go big. Or to benefit, they go big. They don't care by any means possible. Okay? And so even the bad debts that are written off, you have to check the details and make sure nobody's using that as a tool to get money out of the company by misrepresenting transactions, recording them incorrectly, twisting them around to read something else, all kinds of crazy stuff. But people will come up with, this is why the auditor's job, in or out, is so critical. Okay. Then he went down to talk about vouching or checking real estate receipts. Notice a bunch of things. Check everything. Check the inside, the outside, the counterfoil, the receipt number, the receipt sequence, everything. Because remember, you're not checking 100% of the transactions or items. You just simply what? Test checking. Okay. And once you test check and come up with a sample, you vouch. And what does vouching do? It takes all the documentation and you check them. And sooner or later, if there's a rat in the room, you'll find it. You'll smell the rat eventually. But you have to do the process right now to smell the rat. Okay? Interest and dividends coming in from your investments, Mr. Company, Mr. Individual. If you don't take steps to get them, know when they're paid and why, then somebody else will do it for you. And certainly, as we've seen in history, even modern history, that people are always looking for ways to get what is not theirs, okay? Including interest and dividends. All right. What kind of interest you think we're talking to about here? Will you make a guess?
You can repeat the question?
What kind of interest and dividends you're talking about? What do you mean by interest and dividends? Anybody ever heard about dividends at all?
Heard dividends
Yeah, payments by the
from
company,
shareholders.
and the company, yeah.
Yeah, all of the above. Dividends, if you have shares in a company, at some point in the future, the company will, what we call declare a dividend, let's say $10 a share, God forbid, that would be heavenly. But let's say it's $10 a share, and you own 300 shares in Cable Bahamas. And that year they pay dividends of $10 per share. How much do you expect to get in your get a check for? Anyone? $10 a share, 300 shares.
3,000.
$3,000. That $3,000 is called dividends. When a company deposits money in the bank or some other financial institution, they expect to earn what?
Interest.
Interest. And so these are the dividend and interest amounts, items that we are talking about here on this page. And that's why it's important to understand the meaning of these, so that when you hear them again, you will, from your auditors or anyone else for that matter, you will not stop or like, what the hell is that? Okay. Interest and dividends. And so interest and dividends represent income for the company. And so when the auditor comes in, they they are going to be looking at the interest and dividends earned by the company to see if the correct amounts are being posted. Because remember, if somebody's up to no good in the accounts department and somehow the, let's say, dividends come into the firm for $1 million, they say, wait a minute, if I take $50,000 of this transaction, who's going to miss it? I put it in my account. Well, nobody may miss it, or every auditor might eventually find out that something went wrong and you can be discovered. But the point is, interest and dividends are included in their wide spectrum of checks. That's the whole point. And notice these checks so far are very cash oriented. And that's why we talk about them individually, and especially because anything that is cash oriented will be subject to abuse. And you go back into the world of business and Google or elsewhere, you'll see that that is quite true. Okay. All right, keep going, Brian. By the way, what does FD mean?
Fixed deposits.
Yes, fixed deposits. Notice part of the auditor's job for interest from banks, verify the entry in the bank statement. For fixed deposits, check whether any fixed deposit has matured or any fixed deposits were recently established. Why? Anybody knows why the auditor needs to do that? Why is the auditor checking all these savings and fixed deposits so closely? Is cash involved?
Yes.
Yes, yes, yes. So let's say, for example, you're an auditor, but you don't check the interest. Okay, so if the staff knows that you're not checking the interest somehow, then they will just swipe it and nobody will be the wiser. See that? They find a way to move it into their account. If there's a fixed deposit, auditors have to check to see if the fixed deposit's matured. Mature means what? Anyone? A maturing fixed deposit. What does that mean? Maturing-
That means it's
Full
staying in
term?
the good.
Sorry, it means what?
it's reached the end of the selected term that it was placed on. So if
Correct.
it's,
Correct. It reached the end of its agreed term. And then you have to go in if you want to, and either roll it over for another year, or say, I need this money dead bad. I can't roll anything over today. Give me my money and I have to go because I need it. All right. But yeah, imagine if auditors are not checking, 5 fixed deposit for $50,000 or $250,000 suddenly matures, and then instead of rolling it over again as instructed by the customer, if the bank employee feels that nobody's going to be checking that area, then they simply just roll it over into their account or some other account, right? And so the fixed deposit could find itself not in existence anymore until the customer comes and says, "Where's my money?" And you're like, "Didn't you come in and close the fixed deposit?" And they're like, "No, I didn't." And so auditors are always looking for things like this. Okay? All right, keep going, Brian.
Royalty is received. The auditor should see the relevant contract and examine the important provisions relating to the condition regarding the payment of royalties, in particular, the rate of royalties, mode of calculation, and the due dates should be noted. The periodical statements received from the publisher and the calculation of the royalties should be checked. If there is any deduction and account of recoupment from royalties from the prior period, the record for early royalty receipts should be seen to ensure that the amount of the deduction is as per the contract. Royalties due, but royalties due but not yet received should be properly accounted for.
Absolutely. 'Cause,
Audit
sorry, royalties due but not yet received means that you're expecting to get it, but you haven't been paid yet. Until you are paid in the accounting records, it should be shown as a receivable. If you're not checking as an auditor, somebody may not record it as a receivable. They may record it as something else and keep the money. See? Keep the money again.
Yeah.
People are always looking to extract assets out of the companies they work for. Not everybody, most of us are up and up. We're honest, we do things that we need to do. But history has shown there's always a little gang somewhere in every country, in every time period, in every century. AD, BC, doesn't matter who's going to give it a shot, take a risk, look elected, and so on. All right. What are royalties, by the way? Anybody knows? You can look it up in Google. Royalties.
It's a form of an intangible asset.
Okay. That's all Mr. Google said.
No, I didn't Google.
But you're right. It is an intangible asset, an asset that you cannot really see or touch. Definitely. What else is it?
a payment that is made to the owner of an asset or property for usage.
Yes. For example, if somebody makes a song, one of you guys make a song, and somebody else wants to use it, by law, if you're in the right jurisdiction, they should pay you for using your song each time. And how do they pay you? Well, the two of you sit down and agree. Okay, how many times a year are you going to need my song, Mr. Pepsi Cola? Yeah, I said once a month, 12 times. Great. How much money you expect to make from using this song in your advertisement? And then, maybe, 30, 40, $50 million. And you're like, oh man, fire in your eyes. Great. I will require 1% of whatever you earn, whatever the case might be, and they agree. All right. And so every month, the person who made that song, every time Coca-Cola uses that song, they have to send that person or wire that person the amount of money they agreed to. All right. And if the bank is responsible for collecting that money on behalf of its customer, then the auditors are going to come in to make sure that that money is actually collected on behalf of its customer. Because sometimes it's collected, but it doesn't get to where it needs to go. And so you need to check these things to make sure that they're going where they need to go. All right, and then finally, Brian, keep going.
Audit of expenditures, purchases returns. Where a part or whole of the consignment of goods are found to be defective or of poor quality, the goods are returned to the supplier and his account is debited. The debit is raised in the purchase returns book on a debit note. The supplier, on receiving the debit note, issues a credit note indicating his acceptance of the debit. Thus, on receipt, it is attached to the debit note. All these entries should be verified by reference to the record kept in the goods outward box or the store's record. The original invoice through which the purchase were made should be reviewed to confirm that the nominal amount, which was the original debited on the purchase being made, has been subsequently credited in part or whole of the good contained in the consignment that have been returned. Where the purchase returns are large, either at the beginning of the year or at the close of the year, these might be fictitious entries to cover bogus purchases recorded earlier. Therefore, the nature of the transaction must be investigated. The rebate on price and allowances granted by the supplier should be adjusted to the journal on the basis of the credit note received from the suppliers. These should be verified by reference to the original invoices.
Indeed, a lot more accounting gobbledygook. Again, my concern is that you just understand that all kinds of fraud and errors can occur within the day-to-day. Oftentimes, a lot of these are deliberate, as we've seen, and so the auditor keeps coming in on a regular basis, at least once a year, and the internal auditors even more regularly, to check all of these transactional areas to make sure that individuals are not manipulating the accounting or administrative process in any form of organization in order to extract assets out of the company. Remember, however we manipulate paperwork and transactions and situations, the ultimate goal is to get money or assets out of the firm. Okay, unfortunately. All right, great. We'll stop there for the day. Any questions before we break? Fantastic. Remember, I have 2 more modules for you and a grade. If you don't get your modules within 24 hours, somebody send me a note with a funny emoji like, modules. And certainly, if you don't get your grades by just a little later this week, you send me another emoji with hello, grades, anyone? I promise you, I won't be upset with you. I appreciate the reminder. I'll be working to get those done as quickly as possible for you. Any questions? All right, wonderful. Then in that case, you guys take care. Please be safe. And I'll see you again in a few minutes, which will be next Monday. Time flies in case you didn't notice. All right, take care.
All right, good night.
Good night.
Good night, good
Good
night.
night.
Night, everybody.
Good night.
Good night, Indira.
Good night, all.
Hi, Shaniqua, Leticia.